Welcome to this income protection insurance round table, with special thanks to our sponsors Zurich for their support. You're going to be hearing from your peers, from advisors, paraplanners, licensees, insurers and others who are each going to be giving their perspective on the new round of income protection insurance products launched into the market in October. In part one today, each of the panellists is going to be giving their own perspective on the products themselves and the implications they think this is going to have on the broader market. I'm going to start off with Adam, and Adam, get your take on the new round, the new release of all the IP products, your take on it, and also what the Zurich experience has been. And after Adam, I'll go straight to the advisors and we'll work the rest out from there.
Well, sure, Peter. I think, when you look at these changes that have come through, I think the word that jumps to mind is generational. Like, these are such significant changes that we're seeing across the income protection landscape. One which, from a provider's perspective, we really were given not a lot of insight into what other insurers in the market were doing, or indeed what some of the perhaps expectations were from the regulator. So while some of the insights were quite clear, the cessation of agreed value policies back in March of 2020, the way in which life insurers can manage the longer term risk was really up to each respective life insurer. And I think because of that, we've seen quite a differentiation in the way in which many life insurers have really addressed part of the certainly the structure, their design philosophy. And really, one of the things that we did in our product design metric was really to sort of take a step back and not just look at the APRA measures, but what perhaps are critically important to our key stakeholders, licensees, advisors, our existing customers and the community at large. We really wanted to make sure that the products that were going to be on offer in the new world were indeed fit for purpose. We're certainly, focused on sustainability, affordability, but perhaps with one of the APRA requirements, truly are fit for purpose for, clients over the long term. That's
certainly an attitude that seems to have been reflected by other insurers as well. Maybe readings that you might have had. It seems that lots of insurers have taken the opportunity to go back to basics, talk about the fundamentals of IP and what it really means, and canvassed advisors, consumers and other stakeholders. Does that sound about right to you?
Yeah, I agree with that. I think it has been an opportunity for a lot of life insurers, and given there was quite a bit of time, I think it did allow us an opportunity to really step back, as you say, perhaps go back to basics, understand what were the principles of indemnity, really getting back to the core message and value of income protection to really help that sort of sustainability journey, as it were, moving forward.
Okay, fine. So when the rubber hits the road, Catherine and Andrew, what's your take on things so far, your sense of it? You've had presumably conversations with your contacts at the life companies. You've had your own take on trying to analyse the products themselves, and you've had some initial client conversations, presumably. Go to you, Catherine, and then you, Andrew. What's your initial take?
Yeah, certainly. I find that what's come up in terms of the offerings, I think we're looking at a first draft. I think because, as of Adam's comments, the insurers weren't really able to see what each other was doing. We've probably had the most diverse range of products that we've come out to the market to date. I would say prior to these changes, there was many good policies out there, and there was only a few pitfalls that you really had to be mindful of. Whereas now the downside risk is much more significant, and advisors will need to be taking a lot of care to check the fine print to make sure that what they're recommending is suited to the client, because there are more risks there than was there previously. We're seeing more exclusions that weren't built in as standard, that weren't there previously, or were only very limited in nature. And I think in terms of that initial guidance, it's quite clear that some insurers have gone back and looked at their own data to make sure they meet that measure of APRA sustainability, whereas others haven't had as much data, or perhaps the ability to analyse it in time. So they've leaned towards the actuary's reference product, which pulled many levers to address affordability rather than just a few.
Okay, so two things there. You've mentioned downside risk, which I'd be interested if you could just expand a little bit on that, and also the fact that this this growing notion over the last generation that products are commodities and that the real value advice is in the advice, which is correct. But what we're seeing with this new IP range, differentiation has already been mentioned, that there is a wide variance in the types of products that are on offer. So perhaps the first time in a long time, we're not talking about commodities anymore, but we're talking about real choices in product. And I'll throw to you too, Andrew, on that as well. But go, Catherine.
Yes, so some of the exclusions that we're now seeing is built in. Sometimes there was maybe one or two insurer. Typically, you would have had your the run-of-the-mill self-injury, uncomplicated pregnancy, whereas now we're looking at things like criminal activity, illicit drug use, professional, say, loss of license or deregistration. Those things are more common now. But things like sick leave, in the past, it was only if you had an excess store that it would be potentially offset. But if you didn't take it, it wasn't something that was an impact on your cover as long as you didn't take it. Whereas now we're seeing things like sick leave. If you have a significant store, then that will be offset regardless. And some of the insurers aren't offering a great range of waiting periods. So you could have a case where someone has a 3-month waiting period, but 8 months worth of sick leave. I actually come across that situation fairly regularly. So the client may be paying for a 3-month wait, but will not be entitled to receive benefits for 8 to 9 months.
So talking about downside risk in the sense that there are many more pitfalls for advice and serving your client's best interests.
And meeting client expectation, yes.
Sure, okay. Thank you for that. What do you reckon, Andrew?
Yeah, look, I tend to agree with that. I think we saw obviously over a very long period of time, the previous contracts had been around essentially unchanged, probably for most of the 20 years that I was involved. And there was probably a bit of convergence between all the suppliers such that as an advisor giving advice, your principal job was to make sure that someone was protected at the right level. And, you could obviously select agreed value if there was some risk around their, volatility of their income or something like that. Maybe there was some need for some of the ancillaries or not. But perhaps outside of that, just the partial and full disability definitions were important. Whereas now, to the extent that APRA has given this more principles-based approach, it's obviously left the insurers with a greater degree of scope to come up with their answer to that principle that's been assigned to them by APRA. And we've got quite a lot of variation, which probably does make our job harder, and it means matching the client to the right product is probably even more important now than it was in the past. I think maybe Catherine's right. I hadn't probably thought about it previously, but there may well be, this is the first draft. All the insurers have gone away and they've been flying a little bit blind as to probably what their competition is doing, and they've all come out. And I'm sure they'll all be looking a little bit over their shoulders now and fine-tuning and tweaking their products. So maybe we'll see some convergence over time. But right at the moment, the array of policies on offer are probably about as different as they've ever been since I've been in the industry.
Sure. Okay, coming to you next, Leah, but Andrew, as I throw to Leah, has there been anything so far, and it's early days, but any product features that you've just raised an eyebrow over? Is there anything in particular that stands out to you?
Well, I mean, this is probably not a specific product thing, but probably the thing that I've thought was, maybe the worst feature, for want of a better word, of the new product range was this sort of move from an own to an any occupation after a couple of years. Now I know that's obviously going to be across the whole product suite, and probably partly for that reason, we did concentrate in the lead up to this cutoff point, getting a lot of clients of ours or new prospects of ours who didn't have income protection into the existing products before these changes came through, and a lot of people felt there was some benefit in that, and we did as well. And that's probably my biggest concern, and the non-guaranteed renewability. Obviously, after this sort of 5-year term, what contract might you be able to be offered to go back into? Should the insurer be willing to keep covering you?
Okay, very good. So when I come to the licensees, David and Eugene, I'll ask you if you can comment on any activity in the lead up to 1 October in terms of getting clients signed up to the older style product, particularly own occupation definition. That's interesting. Was there a flurry of activity prior to October the 1st is basically what I'm asking. But thank you for that, Andrew. Coming to you, Leah, what's your take on things so far? Have you raised an eyebrow over a particular product or feature. And I understand you're about to write your first product next week or tomorrow or something.
Yeah, there wasn't a lot we could do in the lead up as far as we knew it was coming, but from a paraplanning perspective, we're not seeing clients, we're not doing that sort of thing. And we have to wait for licensees for their specific text or requirements. So there wasn't too much for us to do in the lead up. Certainly as the PDS has rolled out, we all had a good read. I enjoyed the PDS possibly as much as Adam, but I didn't realise they still printed them. So we've got all of those there, and we had a good chat in the team about the opportunities for us as far as we've obviously got risk specialists here with advisors, but not all advisors are. So we are that technical reference point. So just making sure our knowledge was up to scratch with different policies and what it meant for different client groups and client sectors, particular occupations and things like that. I'm based in Townsville, so we've got a lot of mining and army. So the specific things we'd be looking at there. But really with the variety of products, there's an opportunity here that I guess we were excited about, just as far as rather than just running a comparison report and the highest rated product is the best product, that means best interest. That's not ever been the case, but more than ever now, it's about finding the right fit for the client. So rather than just looking at the most comprehensive product, it's looking at what they actually need. So I think that's a good move. I think that's it's going to be interesting to see how that plays out, because it's quite manual at the moment for our advisors. So we've got that first one coming through. So it's been almost a month and we haven't written one yet. And we did definitely have that run up to the end of September where we wrote quite a few insurance plans on the old policies. So we've had a little bit of a break and we're getting ready to jump into it now.
So we move on to you, David and Eugene. Firstly, to you, David, got any comments on what you've heard so far, and also what was the Centrepoint Alliance experience with regard to activity prior to 1 October?
Yeah, well, looking at the changes, there was an influx of business towards the end of the agreed value contract. However, it didn't pan out as expected because COVID threw a spanner in the works with a lot of people losing their job or reducing hours and so forth. So I don't think the surge was as great as what was anticipated. So I guess the next step from there was really looking at the window of opportunity. We had virtually 18 months where you can write the indemnity type contract, which still wasn't profitable, but it wasn't as bad as the agreed value. And the window was to write the indemnity contract with the 3-tier definition. And more importantly, other than just 3-tier, is the actual proof of income, best 12 months over the last 3 years. So that's been pretty much our message. And come 1 October, it's a completely different ballgame. It's a lot more architecture, and even rating software doesn't really give you an indication as to what's best fit for your client.
Okay, because that reminds me of what I was going to ask Leah about, and that's the question. Is it more challenging to establish what is in your client's best interests with this new round of products? I'll go to you, David, and then Eugene, but I might come back to you, Leah.
Absolutely, it is. Absolutely. The risk rating software is pretty much for muchness across the board with their ratings and so forth. But what that software does not take into consideration is the amount of sick leave. Okay, the occupation. You know, if you've got a tradesperson, is an accident benefit more important than someone that's not in the trade? There's a whole range of things, and then there's own occupation definition. And there are just so many different stringents to the product launches, and they vary from one company to another. So now, rather than being, and I was a risk specialist for 10 years, writing the majority of your business with 3 companies, you know, and 5% of that business was going to the other 6 or 7 companies at the time. Now it's a real spread. It's a real spread. You know, what's best fit for your client, and you need to be across all the products.
Okay, thank you, David. So Eugene, there's a lot to unpack there already, but have you experienced as a dealer group head, as a licensee, Is it more challenging to give your own advisors direction about serving client best interest in this new IP regime? And any other comments you'd like to make about flurry of activity prior to 1 October, etc.?
Yeah, look, we had a flurry of activity prior to 1 October. We deal with pretty much all the major insurers. So different insurers had different cut-offs as to when you had to submit applications by to be able to get it through under the pre-1 October rules. So, yeah, there's a flurry of activity, and we'd see that through our vetting process, but also the volume of time-critical forms that came through. You know, usually we get very few of those, but there was a flurry of those. So, a lot of advisors wanting to get their clients under the old regime. In terms of meeting client best interest, the principles are the same, but now that there's going to be such a wide variance between the different types of products, or with the same products across the different types of insurers, yeah, it's going to be a lot harder. I would like to think that software, comparator softwares, will adapt, and because they do provide very detailed reports that break up all the different definitions and whatnot. It is difficult though, because they don't know your client, so you have to understand how to fit that to your client specific needs. And yeah, it really just means that before you give advice on income protection, you need to spend a lot more time doing your research, which essentially just exacerbates a problem that we already have that I think has sort of become more of a problem in the last 4 or 5 years, where you've got a lot of advisors saying, I'm just not going to work with scenarios where the premium is below, pick a number, unless I can charge a fee. And my experience with advisors trying to charge fees for insurance advice is it's very difficult unless it's like a high net worth or high income earner or a professional. The vast majority of clients see the product side of it as the most important outcome, particularly when it comes to insurance.
Okay, and that's a whole other roundtable conversation about fees and advice. And so I'll come to you, Phil, in a sec, but just go back to you, Leah. Is it going to be more challenging for a paraplanner that more and more is working on statements of advice preparation to take into account everything you need to, including what is actually in the client's best interests?
Yeah, I think in the short term, while we're all working out the products, it's definitely going to be a little bit more manual. And certainly some licensees, we've heard what they want, if there's been any changes to the requirements. Others are still working that out. So we're just kind of taking a more conservative view to that at the moment and providing more rather than less. I think our advisors as well are leaning heavily on their BDMs. There's a lot of very tired BDMs around at the moment. Just making sure that we understand the products and what we're recommending to clients for specific risks and that sort of thing. I think, like Eugene touched on, I think the software providers will be working on this. I haven't spoken to them specifically, but I'm sure they're working on it, so that'll help in the longer term. But certainly in the short term, there's a fair bit of work to be done here. And there's a bit of trepidation among our advisors just as far as making sure that they cover off on it. From a purely paraplanning perspective, the other thing is we don't need to put everything we know in the SOA. So we don't need to give the entire story about every product. It's got to be client specific. So just making sure we're not getting carried away with that, because there's so much more to talk about and we get a bit excited about it. But we need to make sure that it's in the best interest of the client and that the client can still read it and understand it. So that we need to keep our focus there. Okay,
sure. So we're talking about issues and issues related to this new round of product releases, but I'm very conscious of the fact that we'll also be talking about it within the context of opportunity, the positives that are going to relate to it. But we're just getting started at the moment, and trying to get a feel for things and trying to work out what's what with regard to best interests and product variation and stuff like that. Phil, do you have your take on anything we've talked about so far, and what the AFA's position might be, or the feedback you've had from your members about the new range of products so far?
Sure, Peter. I might start by saying there's a huge amount of variability in the products. Now, that's in large part, I think, APRA's expectations were, and I think Adam referred to this, were quite defined. But the Actuaries Institute came along and extended the number of variables that might be played with. So, we've got any occupation after 2 years, so own occupation only for 2 years, about income replacement ratios at 60% or below, benefit to age 60 rather than beyond that. And then all the other changes around offsets. So they've thrown all these other issues into the process that different insurers have picked up in different ways. And that's why we've got so many different outcomes here. And I think this is going to continue to play out over a period of time, because the life insurers are going to look at their products and see how they compare in the marketplace. We know there's another major round of change still to come in October next year, when this requirement that policies be refreshed after 5 years kicks in. So what we've now got is a world where the products differ so much, and I think the other comments have been made already, is you can't just have your favourites. You've got to look at a client in deep detail. And Catherine made the point about the difference between what the waiting periods are and the treatment of sick leave. So there are certain products that just won't work for particular clients. And that's why the expertise that's going to be required to give this sort of advice is expanded. And obviously, all the risk specialists are still coming up to speed with how the different products compare. So I think it's going to be difficult for a period of time as they come to terms with this and understand how it might play out. And, we're really only talking about one dimension of this, which is what advice you provide to new clients. We've got the other layer of complexity, which is what advice do you provide to existing clients where they're faced with the challenge of significant premium increases versus the different product features that are in the new products. So there's a world of complexity that advisors are facing at the moment.
We hope part one of this Income Protection Insurance Roundtable has provided value for you. And in part two, our panel drills down a little further into issues including product complexity, pricing, affordability, transitioning clients from old product to new, and how advisors can best help their clients make informed decisions when it comes to this new round of income protection insurance products. And we'll see you then.